Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
And welcome. This is the Investor Coaching Show. I am Paul Winkler. He is Evan Varner. We're talking money and investing. It's better than cleaning up brush.
Yes. And you got to take a shower again today.
I got to take a shower, and I needed to take a shower. I was cleaning brush up this morning. Oh my goodness, I got a trailer full.
Man, I've driven by piles of trees going to and from work. I mean, just these stumps all the way up to the edge of the road. I mean, there's just piles of brush everywhere.
What is it with Middle Tennessee and our junk trees that we've got in this state? At least in New York, we had like pine trees, and they were pretty, and, you know, we had oaks, and we had maples, and, you know, it's like, what are those trees around here? I've been here for more years than I lived in New York when I grew up in upstate. I've been here, gosh, way more years. Almost
30 plus.
Almost 40.
Yeah.
Almost 40 years. Is that scary? Oh my goodness. I think 37 years I think I've been here. But I just don't get these trees.
Yeah.
I just don't get them. They crack like, you know, came down on a fence and tearing it up, and oh man. This is the Investor Coaching Show. This isn't the whine about your landscaping show.
That's right. This is not Tennessee Wildcast.
Okay, so getting right back on the investing topic, shall we? There was a investment firms. We have for 25 years on this show railed against what passes as investment advice.
Yes.
I mean, think about what typically, when you think about an investment advisor, what's their job? A lot of people can get me in the right stocks. You know, which markets, areas of the market should I be in? You know, make sure I choose the right mutual fund. And you know, I've heard for years people say, hey, look at the track record. The 3, 5, and 10-year track record when you're choosing a mutual fund. And I say, well, that's great. You know, you're buying after something's done well. You're choosing a track record. You're choosing something that did well in the past. You know, markets do what? They go up and they go down. What follows up is the down. So, you know, quite often when people are choosing mutual funds in their 401k, they're choosing things that did well in the past. And it's what made it so hard in the past couple of years, you know, for us as, you know, as advisors that follow the academic research and adhere to it. I mean, we're really, really OCD about actually following the academic research around here. And what happened was in the past couple of years, target date funds became all the rage. And the target date funds would do super, super well. Why? Because they happen to be in the area that just happened to do well in the most recent period. Now, if we go back 10 years, 15 years, you couldn't give these doggone funds away. Nobody was investing in them.
Right.
They didn't invest in them or start investing in them heavily until after they did well. And, you know, hence that's why we were railing about that so much here on the show. So they're interviewing on CNBC. Let me just here's the intro. Joe is interviewing this person. So I'll just let his intro tell the story about who they're talking to. Okay.
And Bitcoin and other markets. Joining us now, Mona Mahajan, head of investment strategy at Edward Jones. Reading some of your comments, Mona, it's like we're watching it play out, and I think you can give us some good insight. I mean, overall, the earnings that we've just saw, I guess we're about halfway through. Yeah. Used to think, I guess the estimate was 7%. It's been more like 12%, but 30% in tech, which is pretty good. But in recent sessions, we have seen traders or investors decide that maybe they should look elsewhere in terms of valuation. At least that's what it appears to be.
Yeah, you know.
Okay, so before we go and listen to her answer to that, investors, again, when somebody says we're going to look elsewhere, what is that, Evan, when we say we're going to look elsewhere?
I'll take market timing for 500, Paul.
Evan, I think you are the winner of today's investor coaching challenge. Yeah, exactly. That's exactly what that is. I'm going to change my investment mix based on a prediction about the future. I'm predicting that something else is going to do well. And that is what passes as investment advice so often. That type of prediction, what's going to happen? What do we need to do? How do we need to change our investment strategy? And quite often it's after something like this has happened that was like, oh my goodness, didn't know that was going to happen. They make that change. And how often, I just think about this so often, is why is it, investors, I think of I don't remember which one of my professors actually said this, but he said, we ought to be tripping over Wall Street millionaires.
Right.
We really ought to be tripping over people that have done phenomenally well. And yet we are not. Why are we not? And the reason is because people are approaching the investing process like a gambling casino. And they're investing based on instincts. And our instincts are go away from pain, go toward pleasure. Go toward what just did well, that's go toward pleasure. Sell what just did poorly, that's go away from pain. And then emotions like greed, emotions like fear. I'm scared, I don't know what's going to happen, I'm just going to stick all my money into the backyard. Or loyalty.
I work there. I work for that company.
Absolutely. Or trust. Why do you think investment firms spend so much money on marketing that just has their name out there? They want to create that trust because they know you will invest based on trust. And people think big firm, huge firm, they must be good. They must be trustworthy.
Yeah.
And the reality of it is, with the way that we see that so many of these firms manage money. I mean, I have that one commercial, and it's kind of a tongue-in-cheek joking commercial going, well, the fund company has 1,200 mutual funds. Well, how many funds do you need?
Right.
If you really know what's going to happen next.
Yeah.
And you go, well, gosh, maybe that is a little bit weird that those fund companies have that. There's another firm that advertises that, we do well when you do well. And I'm like, well, what's the big deal about that? Every mutual fund company is set up on that premise. Are you saying that's your primary marketing message? That we do well when you do well? When all mutual fund companies, they have a management fee, and if the assets go up in value, they do better. But yet, the way and I don't have a problem with that model.
Right.
I don't have a problem with that model. But if that's your criteria, and the average mutual fund, like 90% of them over the past 15 years have failed to match market returns, maybe you ought to be just focusing on something that's a little bit more important than just that. Because here's what happens. You would think that'd be a good motivator. And I'm just going to run this by you. Okay. So you're an investor and you go, oh, I like it. The idea that the fund company does better when I do better. But so they would definitely be doing everything they could to make sure that the investments are managed in a prudent manner. Right? That would seem to follow. That makes a lot of sense, right? Here's the problem. How do they get you to invest? How do they get you to put your money over there? This is where the problem comes in the investing process. Fund companies actively try to figure out what areas of the market are going to do better than others, try to buy the right companies that think that they're going to do better. And the reason they do it is because if they get, and hear this word, lucky.
Ding, 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 ding.
If they get lucky and they beat the market, what will happen is that will attract investor dollars. So there's a second way they can make money. They can make money by attracting, and they can't make money if you make money if they don't have any dollars that they're investing.
Right.
So what they've got to do is they've got to do that, and it is the shortest way to get people to invest is to get lucky. And how do we know this? Because this is what happened. Look at when did money start to flow into target date funds after the main area of the market that those funds invested in did better than other areas. Yeah. That is your case in point right there, that is how mutual funds attract your money. We're ordinary enough to think that we can attract and we can have investors work with us if we educate them about the investing process and understand, what am I doing, why am I doing it, and what to expect. It is not based on, because quite frankly, when I opened this company in the year 2000, one of the areas of the market that I would have in an investment portfolio, well, several, I'll give you several areas. Large value stocks, small value stocks, international small, international small value. Large U.S. stocks in the preceding 5-year period did better than every asset category I just named. But the areas I just named did better than large U.S. stocks over the next 10 to 15 years. Yeah. Did I know that was going to happen? No, I did not know that was going to happen. But if I had marketed our firm based on the idea of past performance, nobody would have been interested in what I was doing. Yet, what happened going forward, because it was prudent investing and because it was academically sound, based on everything, all the research that I had been doing and all the people that I had worked with, all the academics that I had spent time studying under, that is what I think that is I look at it and go, I think that is a better way to manage an investment portfolio. It's a better way to manage a company.
Yeah, but I wouldn't even say I think.
I know, you're right.
It is.
Yeah, right. I agree.
And I would add one thing in your mutual fund description.
Okay.
I would add number 3 is, unbeknownst to you, the investor, they're doing the same thing in all of those other categories. It's just they're advertising the category that did the best. Mm-hmm. They've already got experiments going in other asset classes.
True.
And then when the category that you were attracted to and purchased shifts and the wind changes and now it's going down, I can promise you they've got another fund in that new category that has been growing. And so the fund company does do well. The investor just doesn't fare very well on that model.
No, that is so true. And fund companies will do other things that are, you'll have a mutual fund company that might have 8, 9, 10 different mutual funds that invest in the same exact area of the market.
Yeah.
And you go, well, why do they have that many funds investing in the same exact area of the market? Because they know out of 8 different funds, one of them will do better than the other 7. And that is the one, as Evan is implying, that will be marketed. And that is a game that the investment industry has played forever.
Yeah.
So hence, what so often happens for investors, I'm just thinking about, was it Charlie or is it? Yeah. Well, I'm thinking about John Bogle's talking about this very topic right here.
The reason we do all this, create all these funds, is because this is a marketing business, has become a marketing business. And what's going on here is, for example, when we have the new economy mania of the late 1990s, people create internet funds. They create telecommunications funds. They create technology funds. A whole lot of funds focused on the fads and fashions of the day. And guess what? The reason they're fads and fashions is those stocks have gone way up. So the investing public comes in, buys these new funds, and as soon as the public gets in, down goes the market. This has happened all through human history.
It's sad.
You don't want to pay any attention to the fads of the day except to ignore them or to avoid them.
And that's exactly what and then what they'll do is they'll have a manager, hey, look at this. This manager's done really, really. I remember working for an investment firm and they would go, hey, this is the great manager. You need to be putting your clients' money with this fund.
Yeah.
And the next year they would have a different manager that they were parading in front of us. And I'd be like, well, what happened to the manager from last year? What happened? And, well, it didn't do so good. We got this new fund right here.
He retired for personal reasons.
And yeah, exactly. And Bogle addressed that as well.
The other myth is that there's some way of picking managers in advance or picking managers for the future based on what they've done in the past. There is absolutely no evidence that performance persists over the long term. If you look at the best 10 managers in a given, say, 10-year period, the chances that they will end up above average in the next 10 years is about 50-50. Half will, half won't.
That's probably being generous.
Why would people want to bet that way?
Yeah, that's probably being generous to even say that. So you go, well, okay, so why, what are they talking about with the managers there? What is the manager's job? In this particular instance, what they're doing is they're trying to figure out which companies are better than others in a stock fund investing in large U.S. stocks. And then they're moving money around. And that's what they perceive their job as being. And the public perceives their job as being that. And the reality of it is the mutual fund company can do well.
Right.
And you not do well.
Yes.
That is the point I want to make. And that is one of the things I object to that type of advertising when I hear that kind of thing, because I just go, wait a minute, that sounds really good, but that's not necessarily what is happening so often, because the investment industry is driven by using track record to try to attract money and then knowing that it may not continue into the future. Because the reality it usually doesn't. Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement. Real estate, life insurance as a retirement investment, and annuities and interest-bearing accounts and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. Hey, what's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. So there was a segment on CNBC where Joe is interviewing this lady from Edward Jones, and she was, talking about the markets and some surprises that came in regarding stock markets and, just the interesting things that have been happening. And you think, okay, well, so what are you doing now? As an investment firm that's one of the largest investment firms in the country, maybe even the world, I don't know, but, all over the place. You see them all over the place. You're managing huge sums of money for investors. And you've been watching what's been going on in markets. What are you doing now? Now that some of these areas of the market have just melted down, that were so popular and that had been doing so well, and they just haven't, like last year, the returns of the S&P were okay. But it was a fraction of a lot of other areas of the market, quite frankly. A tiny fraction. And, a lot of investors weren't terribly well diversified, so they were okay. They're complacent. I had a little bit of return, in my portfolio. But the reality of it is they were missing so many areas that had done so much better. And so far this year, again, in recent history, we've been seeing some of these markets drop in value. Matter of fact, there was a really interesting article about how it says what to know about Anthropic and OpenAI. And this is the models are rattling stocks, is what they said in this article. And then what they're talking about is how Anthropic's new legal tool can review contracts and perform other industry-specific functions, and analysts have suggested other specialized business capabilities will surely follow. And all of this is really, as they said, artificial tools are improving at a dizzying pace, and they're branching into new specialized areas. And this created fears that AI could supplant traditional software services, hammering a broad array of stocks as a result of it. So there are companies that were super, super popular in 401k plans and investment plans that investors have, and all of a sudden just got hit on the head and nailed over this whole thing. So they're interviewing this lady from Edward Jones right after this announcement came out, that this is why these stocks had been hit so hard. So what does she say we need to do as an investor now? Oh, well, you got to hear it for yourself. Yeah, check this out, Evan.
Yeah, look, I think it's been a tough week for those investors that were exposed to the parts of the market that have really led to the upside. Think about technology, AI, but also more recently, we've seen gold and precious metals sell off. We've seen the Bitcoin crypto space sell off. I'd say broadly, if we take a step back, we still feel pretty good about the direction of the U.S. economy. We think it's growing above trend. We feel pretty good to your point about earnings. We think still double digits earnings this year.
Now, we feel really good. We feel. And so, it's really great to invest based on feelings.
Absolutely.
It's kind of how
Works
we are
every
as a
time.
culture now, isn't it?
Works every time.
It's our cultural thing. We got to just do everything based on feelings. Now, seriously though, we feel good about the economy. That presupposes that stock markets go up when the economy is good. It presupposes that the stock market goes down when the economy is bad. That is not how stock markets work. The economy was doing wonderfully well, fairly decent in 2008. That didn't stop the stock market from dropping precipitously, U.S. stocks from dropping precipitously in that particular year. The economy was doing pretty poor in 2009 and 2010. That didn't stop the market from going up. So markets can go up when the economy is bad, and stock markets can go down when the economy is good. And the reason is this: the stock market is a leading economic indicator. The stock market went up in the past because the economy was going to be good. So the whole idea being talked about here, let me just replay it again. I want you to hear this.
Pretty good about the direction of the U.S. economy. We think it's growing above trend. We feel pretty good to your point about earnings.
We think it's growing up. So the whole idea right there is just, I just want to make sure you heard that was her premise for saying, hey, this is okay. Even though we were in some of these areas and we were heavily in these areas that just took it on the chin, it's okay. We think it's still okay. But listen to her game plan going forward. This is the strategy. Ready? Okay, here.
It's still double digits earnings this year, which underpins stocks. But we do think you have to start thinking about diversification.
Where do we start? We should start thinking about diversification.
More prudently, more seriously.
We ought to be more prudent.
What an idea.
You just got to, I got to play this again.
You have to start thinking about diversification more prudently, more seriously. Parts of the market that have held up well, value cyclical, market caps in small cap and mid cap. And then, of course, when you look regionally, EM and international have held up better as well. So there is an opportunity out there. We think it's just a diversified opportunity.
There you go. Now that that's gone up in value, I think there's an opportunity, Evan. Let's buy that thing.
Those. That's scary.
Really. That is scary. Thank you.
She has a degree from Wharton. She went to Harvard Business School. Where else? She's not stupid. No.
She went to I don't want to imply that.
University of Pennsylvania School of Engineering. And yet there's still an emotional, well, let's just chase the hot thing. This is a good time to diversify.
Yeah, Evan, now that, last year, international small value stocks went up 52%.
Yeah.
I think it's a good time. Maybe we ought to buy that now.
Yeah.
In what world do you go, yeah, now that my house has tripled in value, I think, that house has tripled in value, I think I ought to buy it.
Right.
Now that toilet paper is selling for 4 times what it normally sells for, I think it's a great time to buy it. No, that doesn't make sense. But yet that is investment advice. That is what we typically hear. And you think, boy, that sounds prudent. And she used the word prudent.
Right.
And what does the prudent investor rule actually say? Diversify before this happens.
Right. Gosh.
I mean, that is the American Law Institute, the Prudent Investment Restatement of the Law.
The seductive nature of that whole emotion is that we do it in a lot of other areas of our lives, but with less consequence. So, for example, for a while, I just haven't followed college sports all that much. Between work and grandkids and whatever, it's just not high on my radar. But about 6 games into the season, Texas A&M was undefeated.
Okay.
And then 9 games into the season, we're still undefeated and so forth. So I started paying attention to the Aggies again, playing, hey, we're undefeated season. This is great. And now that I'm paying attention, we got killed in the first game in the college playoffs,
You're bad luck, aren't you?
Yeah, I shouldn't have watched the game. But, we do that. It's like, oh, okay, let's do this. Kind of a bandwagon. I mean, I went there, so it's not a bandwagon thing. Sure. But now I'm paying attention to it because it's got this success. I'm going to jump on, and then it reverts to the mean, unfortunately.
Yeah,
we call A&M.
We call that Berg. Basking in reflected glory.
Oh, I like that.
Yeah, there's actually Berg. Yeah, it's the Berg effect. So the idea that, why is it that we go to our favorite team and we go, woo, we won, we won. No, they won. You were just watching.
That's right. But in investing, you pay a price for that.
Yeah, it's absolutely true. But at, the cocktail party, and as they jokingly say, people go out to, hanging out with their friends and go, yeah, I own, and they'll name the company that they own that did well. They'll ignore all the companies that they own that just, took it on the chin, but they remember the winners, and because people in general just want to think of themselves as successful. They want to think of themselves as smart. They want to think of themselves as prudent and well-educated and well-informed, because it feels good to be that person.
Yeah.
And they'll often talk about their glories and they'll forget their losses. Now, some people are the other way around. There are people around that, all they do is bask in their losses, and that can be a problem as well. But recognize that when somebody talks about how well they've done, I remember this one guy, and I'm not, this huge Tony Robbins fan by any stretch of the imagination, because, you like him. There's some stuff I could take and live. I think I got my taste of so much motivational stuff when I was in my 20s.
Yeah.
That I'm like, I just leave it now. I'm like, I don't want to hear that stuff anymore. But he did tell this story. He had a guy in a workshop one time that had done really well in, I think it was the late 90s. And this guy was struggling. And he says, sir, what's wrong? And I'm paraphrasing. It's been a long time since I listened to this. He goes, what's wrong? He said, here's what happened. He said, I was doing really well in the stock market in the late 90s. And he said, my friends and my family, they were begging me to take over their portfolios. Just begging me, can you do this? And he says, and I fought it. I didn't want to do that. And he said, finally, I gave in. And I decided I was going to help them manage their portfolios. Because what happened? He basically came away with the idea that his good performance was due to skill. And he was convinced, actually, that, and maybe his friends and family convinced him that the reason he had done well was due to skill. Well, what ended up happening is, of course, the markets turned in 2000, 2001, 2002. And he actually ended up losing, I forgot, all their money or most of their money.
Yeah.
And he just felt the level of guilt he felt was absolutely awful. So recognize that, when people talk about their great prowess in investing, recognize that you take it with a grain of salt, because many times people will talk about their victories, but they won't talk about their losses, especially when it comes to investing. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.